you're watching Your Money Matters here at NDTV Profit. I'm Mahima Vajrajani. Today we've picked two very interesting topics. The first one being how any investor should be wary of investing in an NFO. And to discuss exactly this, we're joined by Kirtan Shah, who's the founder and CEO of Tuvanta Wealth, joining us now. Kirtan, hi, a very warm welcome to you, and thank you so much for taking out the time. You know, of course, my first question to you will be, I saw a video where you were mentioning as to how investors should be wary of investing in an NFO. Why is that, is my first question.
Mahima, thank you so much for having me on the show. Mahima, I think because the mutual fund industry has been around for quite some time, and in most of these categories, you have at least tens of funds with great performance history, and you can actually go back to and check why and how the funds have done when markets were good, markets were bad. You have a consistency to look at, you have a risk adjusted data point analysis that you can do. And when all of these things are available, right, why do you want to invest in a new NFO which typically will not have any of these things, and you are just taking a blind bet because probably the brand name is too strong for you to invest? So what I keep telling investors generally when I talk to them is that if there is an NFO which is coming out which is not offering you anything new, and then there are existing opportunities in the same space already available where you can dig a little deeper and try and understand how the funds traditionally would have done, or rather have done, then why do you want to invest in an NFO? You have multiple other options to look at.
You know, exactly that, Kirtan. So even I was having a chat with a friend the other day. The idea is that none of these NFOs that have come out in the recent past have anything new to offer, right? The theme on the back end remains the same, which is already there in the already existing mutual funds. So if you can, you know, give our viewers a perspective as to how these NFOs are, you know, have nothing actually new to offer per se.
So Mahima, like you rightly said, most of these NFOs that are coming out are all absolutely the same thing bundled slightly differently, right? And hence, I typically believe that the only reason why you should typically go ahead and end up investing in an NFO when the NFO has something new to offer. Like say, for example, just because we are discussing this topic, let's take SIFs. Right now, SIF is a completely new offering in the MF space, which does not currently exist, and it is offering you something that probably you will have to invest at least 1 crore to take exposure in a product like AIF. Right, so you have 25% unhedged derivatives that the fund can actually invest in, and you don't have a mutual fund product offering this. Now, if this is something that is offered which is not currently available, then probably a certain section of the investor community may want to look at an offering. Now, having said that, it does not mean that probably because the product is offering something new, you should go ahead and invest. It should also end up solving a problem in your portfolio. Now, even if a new NFO comes out which is offering something new, but that is not a problem that your portfolio needs to solve for, then in that case also you don't need to invest, right? Like say, for example, in SIF, of course, there is a 25% unhedged derivative position that can be taken, which is not currently available. But the minimum ticket size in terms of investment is 10 lakhs, right? Now, you have to understand whether that kind of exposure is okay or not okay for your portfolio. And is it solving a problem that your portfolio currently does not solve for? If yes, then you go ahead and invest. Otherwise, in most other cases, you remove the SIF aside, right? Like we are discussing, it's all the same thing bundled in a new gift wrapper.
Absolutely. And, you know, just to extend that, my next question is that, you know, a lot of people misunderstand that, you know, a new fund offer is similar to an IPO, which is not the case, right? It's not exactly, you know, like a new listing per se. So just want to give viewers a perspective about how NFO is not like an IPO, because at the end of the day, the NAV is something that matters.
I think you've touched a very interesting point because I got a lot of comments when I put that video out saying, you are missing out on a great point that the NFO comes at 10 rupees. And what is very unfortunate that the investor community does not understand is that the NFO at 10 rupees solves no problem. Because what you have to understand is that in the world of investing, everything is in percentage term. So let's say, for example, if there is an NFO which comes at 10 rupees and it has to go up 10%, right? The 10 has to become 11. Now, a lot of investors think it is easy for 10 to become 11 versus probably a 250 to become 275, which in percentage terms is the same 10%, but it's actually not that, right? A 250 will take the same opportunity cost for it to become 275, which is 10% returns, that a 10 rupee NAV will take to become 11. So I think it is completely futile to think that because the NFO is at 10 rupees, I am getting it at a cheaper price. It is like saying that a 10 rupee stock is cheaper than a 250 rupee stock listed on the exchange, which is no logical comparison as such, right? So don't look at NFO because you think that the NAV is available at 10 rupees. It actually is no sweetener in terms of an offer. And when you talk about an IPO is a completely different story. It's an existing company which has been working but not listed, and now it is listing to probably give an exit to a private equity investor or probably raise money to grow faster, right? It has nothing to do with how an NFO works. An NFO is a new fund that an AMC is offering, asking you to invest so that they can deploy that money as per the objectivity of the fund.
Okay, all right. Because new fund offer does not have any past record, just want to get a sense as to how much should investors weigh on the past performance before selecting a scheme?
So I think that's again a very interesting question because past performance may not repeat, and that's exactly how you want to make sure that the investor community understands when they are investing. Because the general problem is today when a retail picks a scheme that she wants to invest in, she look at the 1 year, 3 year past returns and then invest. The point is not that the past returns are good and hence you invest in that particular investment opportunity. But at least when you have a 10, 12, 15 years of horizon, right, that you want to invest for, and at the same time you have 10, 15 years of history of the fund which is available, then I think it only makes your job easier to understand. Because let's say, for example, from a viewer's perspective, let's say if you have a fund which has probably seen a 2000 fall in the market, it has seen a 2008 crash in the market, 2013, 2018, 2020, and the fund historically, given having seen all of these cycles, still have been able to beat the index, right, by taking lower risk, then I think that gives you far more confidence for you to be able to invest in that fund versus a fund which has absolutely no history to look back on. So my perspective of saying that you should have a history was in this context, so that you can understand whether or not the fund has actually seen cycles and what and how has the fund done in those cycles. I think that's a great value add when you have so many of such funds available versus wanting to invest in a fund which has none of these things to dip down on.
All right. Kirtan, the other aspect is that in the recent past, we've seen a lot of sectoral and thematic NFOs that have come out. Just want to give your perspective, just want to get your perspective on how dangerous these could be. Although in the past couple of months, we've seen the inflows in these thematic mutual funds go down, but NFOs have been subscribed quite a bit. Your view on this?
I think I have a very strong view, and I keep generally discussing this online, which is that whenever probably a thematic or a sectorial investment opportunity is made available to you, you've actually lost out on the cycle already. Because most of these thematic funds are typically bought to the market when the cycle has already played out. So let's say you've had a 6 months, 10 months, or a 12 months of a sector really doing well is when this thematic investment comes into picture, right? So while you invest in that thematic, please understand, because there is too much of noise around that particular sector and that sector has done really well, is where that thematic play has actually reached out to you. So there are two things. First, you are already probably late in the cycle. And second, at the same time, as a retail investor, you have to understand that whenever you are investing in a thematic play, you only need not get the entry timing correct, but you also have to get the exit timing correct, because thematic plays are extremely cyclical, if you don't get your entry as well as exit correct, then you probably are in a loop where you are going to continuously keep underperforming. So I think thematic and sectorial pay is not for retail investors. It's more for sophisticated investors who know why they are investing in that particular sector and have a slightly better sense in terms of valuations of entry and exit.
Okay, fair point. Kirtan, any scenario where you think that NFO actually makes sense for investor or not at all?
Like I said, if the NFO has to offer something completely new that is not existing in the market, you should definitely look at it. Point in case is the SIF. I think what is currently offered in an SIF is a very similar structure of what an AIF on a long shot offers. But of course, because the minimum ticket size is 10 lakhs, your corpus in terms of existing investments have to be slightly higher to be able to take a bet on SIF. And because it is very personalized, it has to solve a problem in the portfolio. But largely having said this, I think SIF is something that definitely the investor community can look at.
Kirtan, the other aspect is, we who track the space closely know about how important it is to track the fund manager's performance as well. But a lot of investors out there are not aware of this. What would you want to tell them?
No, I think, look, there are, like, say, for example, somebody like me looks at some 21 data points before we end up selecting or rejecting a scheme in which we want our investors to invest. Now, this level of sophistication in terms of selecting is not something that you will typically expect a retail to look at, right? So, if you are a retail investor, ideal situation for you is to invest in an index because it is extremely simple and you don't have to really bother about selecting one or two funds out of the bunch of 100 funds available in the market. So as a retail investor, all you have to do is control your behavior, look at investing for as long as you can, and don't get scared when the markets are dipping. Even if you do index, I think you will end up doing a much better job. Active is slightly more sophisticated in my opinion, and that is for people who are looking at alpha over the index, right? So as a retail investor, stick to index and make sure that you have a longer time frame in terms of investment.
All right, Kirtan. I think the conclusion of that chat is that, unless and until the NFO does not offer you something new which has already not been present in the mutual fund space, it doesn't make sense to invest in NFO. Thank you so much, Kirtan, for taking out the time and, of course, giving us all those insights.